Welcome to the program. This is Business Morning. I'm Ladi Williams.
Good morning. I'm Ini John Mekwa, and this is Business Morning. Well, only 5.73 trillion naira has been invested in the manufacturing sector in the last 8 years, despite the numerous opportunities, and that's according to the National Economic Summit Group. In its 2021 macroeconomic report, the private sector-led think tank explained that policy and regulatory inconsistency was a major reason why the manufacturing sector recorded a trade deficit of 11.76 trillion naira last year. It adds that the cement, food, beverage, and tobacco, as well as textile, were 3 of the 13 subsectors which accounted for 77% of total manufacturing outputs.
And Ekiti State is set to reawaken the edge it has in rice production as it becomes the first state in the southwest in recent times to unveil the Rice Pyramid Project initiative of the federal government. The pyramid concept being undertaken by the Central Bank of Nigeria under the Anchor Borrowers Program is in partnership with Unity Bank as well as Rice Farmers Association of Nigeria to strengthen food security in the country. Do take a listen.
These pyramids signal a bold return to agriculture, aligning with the call for economic diversification as the National Rice Pyramid Program is launched in Ekiti State with 278,000 metric tons of the grains in partnership with the Central Bank of Nigeria and Unity Bank. The governor of Ekiti State, Kayode Fayemi, says the state is ready to regain its ancestral position as a major player in the rice value chain.
Ekiti used to be the leading rice producer for the entire western region of Nigeria and beyond. We're determined to regain our pride of place by building a successful generation of players in the rice value chain.
For the governor of the Central Bank of Nigeria, speculations over lopsidedness in the Anchor Borrowers Program is inaccurate.
More than 300 billion has been disbursed either through Anchor Borrowers Program or through states or to companies that are operating in the southern part of the country.
Private sector player Unity Bank has been a major partner of the Central Bank on this agricultural initiative. It says it is determined to help Nigeria attain food security while assuring rice farmers in Ekiti State of input support.
At Unity Bank, we are ready to continue to give the necessary support to the federal government, the CBN, in terms of all the laudable projects they want to do to improve, the agricultural situation in Nigeria in order to provide, food, so that we can be dependent on our own production and provide food security for the country.
In 2019, Unity Bank won the Presidential Award of Recognition for the bank's strong participation in the Anchor Borrowers Program, and it expresses willingness to do more.
Well, the Debt Management Office has been speaking on the 2.374 trillion naira loan request by President Muhammadu Buhari, stating that it's been captured in the 2021 Appropriation Act. A statement by the Debt Office explains that the new capital raising has already been approved and is now being presented to the National Assembly in line with the DMO Act 2003. It adds that the loan is to be used for capital projects in various sectors of the economy, including power, transport, agriculture, and rural development, which are already included in the 2021 Appropriation Act. Well, external debt stood at $33.34 million as at December 2020. This was released in March 2021, while as at September 2020, it was $31.98 million. Rising debt stock of the country has been a source of concern for some Nigerians, but some economists have said that the focus should be on the use of the loans. Well, let's get the views of Oluwadara Olunuga, investment analyst with AfriInvest Securities Limited. Good morning, Oluwadara. Thank you so much for joining us.
Good morning, Minnie. Thank you for having me.
Yeah, you're welcome. So let's talk about the purpose of the proposed $6.2 billion loan, especially considering that the FG sourced external borrowing from institutions such as the World Bank and IMF in the aftermath of the COVID-19 pandemic.
Okay, so the new proposed borrowing is meant to just fund the budget deficit, like you mentioned earlier. But the 2020 situation that you mentioned is quite unprecedented. A lot of countries went into recession, and then at the peak of the pandemic, there was a lot of raising of funds from multilateral institutions. Take, for instance, Nigeria raised funds from the IMF, from the World Bank, and even from African Development Bank, that's AFDB. And Nigeria is not alone. About 34 sub-Saharan African countries raised about $16.3 billion from IMF in 2020 alone. Like we all know, most sub-Saharan African countries are commodity dependent. And seeing what happened to a lot of commodities last year in terms of pricing and demand slump at the peak of the lockdown, and even seeing oil prices crash last year, a lot of sub-Saharan countries could not fund their budgets alone. There was need to source for funds outside. And of course, Euro bonds market or debt market was a no-no given substantial decline in credit ratings for most of these countries. So the last result was to seek funding from these multilateral institutions at relatively favorable conditions and terms. Yes. So that was what happened for that borrowing last year.
Okay, all right, but what are the implications of this loan in the light of the provisions of the 2021 fiscal budget?
Okay. Like I mentioned earlier, this borrowing has already been provided for in the 2021 appropriation budget. So the budget has an unprecedented level of expenses of 13 trillion naira, which is like the highest that the country has ever planned to spend in a year. And although revenue is also expected to come in at a very bogus 7.9 trillion, which a lot of us question how realistic it is. Budget deficits, proposed budget deficit is already 5.6 trillion naira. And 4.6 trillion of this is expected to be sourced from borrowing. That's 2.3 trillion from domestic market and then 2.3 trillion from the foreign markets, which is the 6.2 billion that the government is proposing right now, right? But history suggests that proposed deficit is always less than the actual budget deficit. That's at the end of the day, there's going to be revenue underperformance and there's going to be a lot of debt. Although capital budgets will absorb most of this and capital budgets would underperform significantly relative to budget, but then the deficits will come in because of the gap in the spending and then the revenue.
So I'm talking about debt to service revenue ratio, which surged to 83% in 2020 from 50.7% in 2019, implying that the federal government pays 83 naira to service debt for every 100 naira in revenue. Although debt to GDP ratio at 29.2% still remains favorable, does this paint a worrying picture, or is there room for increased borrowing based on the debt to GDP ratio?
So, in line with what the Minister of Finance always reiterates, what Nigeria has is a revenue problem. What we have is underperforming revenue generation. Last year, we were only able to generate about 3 trillion naira, although we saw what happened to oil price shock and then the non-oil economy was on a standstill for months. So, despite even taking away the effect of the pandemic, revenue generation has been weak over time. So declining revenue and increasing debt and debt service costs. For instance, as at the end of 2020, debts burgeoned to about 33 trillion naira from 27 trillion naira as at the end of 2019. Then we had currency devaluation. All this would, especially for external debt servicing costs, is to increase debt servicing costs. And the base, which is the revenue, continues to decline. That means the ratio would worsen. And we are at an unsustainable level, 83 naira out of 100 naira for just debt service, when we had other recurrent expenditure like salaries, and we have not started talking about capital expenditure. So what we have is a revenue problem, not a debt problem. But then unless we are able to solve the revenue problem, we have to control the amount of debt that we carry. Yes, the debt to GDP ratio is currently favorable at 29% compared to the IMF recommended threshold of 56%, and compared to what some other African countries are currently operating on. But since our debt servicing capacity is capped by the amount of revenue that we can earn, we have we have a revenue problem, and we have to curtail our debt until revenue grows substantially. And we're able to
All right, Dara.
this debt service.
Yeah, Dara, but some analysts argue that we actually have a spending problem. What do you think about that?
Okay, so just I will relate it to an individual, right? There's this adage that says cut your code according to your material now, not even according to your size. So you can be a size 14, but you have to learn to spend in line with your earnings. We are not earning that much, so we should be spending in line with our earnings. So for analysts that argue that we have a spending problem, yes, they are right, because we are not generating for an economy as big as this, the largest economy in Africa. We are not generating enough revenue. The revenue source is not diversified enough to fund the level of expenditure that we are looking at.
Why does it seem so difficult to deal with this revenue problem? I mean, we keep saying Nigeria has the potential. In agriculture, we have the potential. In ICT, we have the potential. Why can't we overcome this revenue problem that is seems to be the biggest hurdle?
So there's a lot of concentration in terms of revenue generation. So about 50% of the revenue is expected to always come from the oil sector. And the world is even moving away from oil, which we should start considering other sources of revenue. So although the CBN and the federal government is investing a lot in agriculture, but what we keep seeing is that there's significant underperformance because of a lot of other bottlenecks. Take, for instance, the investments in capital expenditure, which is supposed to boost sustainable growth in the economy, is very poor. So in an economy where there's no light, where there are no infrastructural facilities, where the road network is very poor, transporting even the agricultural products to Lagos, where it now makes sense to sell them, is very poor. And then there are a lot of wastages along the line. So for revenue generation to be stable, there needs to be investment in infrastructure. Those are the long-term sustainable sources of growth for any economy. So that
That's
is
what
why
this
our
loan,
revenue.
but that's what this loan is supposed to do. It's supposed to help us develop our infrastructure to deal with the revenue problem, I guess.
I fear that that won't be the case if we have to pay so much of this debt service. So the case is like now we are going to be borrowing to now be funding borrowings, right? Over the years, capital expenditure has always been the one taking the hit of our revenue problems. So we see recurrent expenditure, of course, have to go on. We have to service our debts. Nigeria has never defaulted on any loan. We have to service our debts. We have to pay salaries, and then we've also seen spending in subsidies. Although now the government is taking off subsidies gradually in line with the agreement with the World Bank, say electricity subsidies and petroleum subsidies. But those are the things that have been consuming a lot of government funds over the years.
All right, given Nigeria's current credit rating and the sentiment in the Eurobonds market, where do you see the pricing of this loan in the Eurobonds market?
So currently, Nigeria is rated B with a stable outlook by Fitch and then S&P, but we have a negative B2 with a negative outlook from Moody's. Albeit, we still expect favorable pricing from the Eurobonds market. I'll give you an instance. Average bond yield in the domestic market now, domestic bond market is 12.3%. While average bond yield in the Eurobonds across SSA instruments is about 7.5%, and average yield across Nigerian Eurobonds instruments is about 5.7%. Compared to 12.3%, that is like the very favorable terms for borrowing, one. And then number two, take for instance, the 2049 instruments in the domestic market is priced at 14%, while it is priced at 7.9% in the Eurobonds market. So I will still expect that we will obtain favorable financing in the Eurobonds market, given our current rating. And the fact that the advanced economy is awash with a lot of liquidity, there's been a lot of accommodative monetary financing to pull out the global economy out of the recession that we saw in 2019. So this improved liquidity, and given that there are prospects in this economy in terms of the fact that Nigeria has never defaulted on any loan, and then that stability that gives investors confidence to borrow, to lend to Nigeria. So I believe that there will be favorable funding in the Eurobonds market, even compared with domestic markets, where we've seen yields rising substantially over this period.
Okay, so what are the implications of this loan? First, to the country's foreign reserves, which measured at $34.8 billion in March, and then compared with $35.1 billion in the previous month, as well as the implication in the domestic bonds market.
Okay, so for the external reserves, this borrowings would actually boost external reserves because the borrowings they are coming from multilateral institutions, bilateral institutions, and international capital markets, that's Eurobonds, and they are going to be in dollars, obviously, and that's going to fuel excess external reserves and also strengthen the ability of CBN to support the currency, possibly. And then for the domestic bonds market, I don't see so much of an impact because the domestic bond market has been responding to domestic fundamentals recently. We've seen increase in yields in response to high inflation and also tightening liquidity in the economy. So yields are continuing to rise on this basis. And those are the factors that I expect will continue to determine the performance in the domestic bond markets going forward.
All right. What about looking at the equities market? We still have this bearish trend going. What's your outlook for the equities market going forward?
So equities markets will majorly be driven by fundamentals, like I mentioned. So the market is not deep enough. We've seen a lot of outflows from foreign investors in the market. So we would expect that going forward, companies that are able to deliver despite ease that has been taken in 2020 relative to peers in the industry and relative to the Nigerian economy would enjoy favorable pricing. Take for instance, countries that are able to still see top line growth and they're able to ensure operational efficiency to maintain bottom line stability, and especially companies that have been over the years that have paid stable dividends would enjoy premium pricing. So it's not a general market play because for every sector that is not expected to do well, for companies that are top, we would expect investors to pick interest and then the pricing to be premium on the exchange.
So where do you see global oil prices this year? I mean, considering that it will greatly affect revenue and in turn it will affect the debt servicing capacity of the federal government.
So unlike last year that we had global oil prices averaging $43 per barrel compared to $64 per barrel in 2019, and we saw that Nigeria government had to reduce at the peak of the pandemic. They reviewed the budget assumptions and said, okay, we're putting it as a base of $28 per barrel compared to $56 per barrel initially, and then it closed higher by $43 per barrel. This year, we're more likely to tilt our outlook to the outlook of OPEC and the outlook of EIA, that's the Energy International Agency. And both agencies are expecting oil prices to tail above $62 per barrel this year. That's again barring the impact, barring any unforeseen contingencies on part of the pandemic, because now we've seen new cases, new variants in Brazil, in India, and if this persists and spread across other regions and influence movement and lockdowns, the demand pressure may pull oil prices lower. But now we are aligning with that forecast that oil prices should close at above $62 per barrel. And of course, we know that that's very positive for the Nigerian economy in terms of revenue, in terms of external reserves, and in terms of debt servicing capacity.
Okay, considering most countries are moving to greener sources of energy now, how would you advise the federal government right now, considering, now we're having more electric cars being produced, what should we be looking at right now?
The Nigerian economy should actually look beyond oil for revenue. The Nigerian economy should actually invest more in its people, because if you see the level of remittances over the year before the pandemic, remittances have always now exceeding the receipts from oil. So we have the people, we are supposed to invest in health, invest in education to ensure that we have a very strong and educated mobile working force that we can now export. And then we can also earn remittances from there. There are a lot of Nigerians working from Nigeria and earning in dollars, which is earning the country foreign exchange. So I believe that investment in people, investment in health, investment in education, which has always enjoyed a very, very slim voucher of the budget over the years. I think that's where we should focus on. We should focus on those sectors, build the people, let's earn remittances. Also, we should focus on infrastructure, like I mentioned. A very fantastic road network, stable electricity would ensure a lot of productivity and reduce wastages and costs significantly for people and boost productivity and the Nigerian economic growth.
Dara, sometimes when we have these conversations, it seems it's just so perfect, when we are talking about it. But when we're talking about the implementation, even you talked about it, we need to remove subsidy, and then that will save the federal government some money. We need to invest in people. Now we're having to take loan. At what point do we start the implementation? From where do we get the breakthrough? If the federal government is saying already there's less cash that is needed to do some of this thing. At what point do you see the country beginning the implementation of investing in people, investing in infrastructure, and still dealing with the issue of subsidy because the people are not really willing to pay more? Where do we get our break from as a country?
Honestly, it is easy to analyze these decisions, like you mentioned. It's easy to talk about it and give policy framework and policy guidelines. But you and I are not at the helm of affairs. We don't hold the kids to a lot of decisions. Decisions lies with lawmakers, lies in their decisions, and it also lies in their level of understanding. So it is important that you see people that are not economists tell you, oh, close the borders or restrict access to milk, restrict access to maize, when they don't even know the implications in terms of economics. So everybody wants to operate a closed economy. Let's produce everything that we eat. Let's produce everything that we eat. So it's easier to drive when you're not at the wheel. That is what I would say. It's easier to drive and say, oh, park like this and rewind like this when you're not at the wheel. But when you're at the wheel, it is tougher. There are a lot of suggestions being thrown in your face. There was a time the president instituted Economic Advisory Committee, and then we saw some recommendations from the committee, including the removal of subsidies, like I mentioned. But then the implementation has been slow, if at all, and positive at all. So This subsidy removal that we are seeing, we've always advocated for it. But the reason we're seeing it this year is because the World Bank listed this as one of the conditions for assessing the $1.4 billion dollars that we assessed last year. So we are not at the helm of affairs. We keep advocating that policymaker listens to economics and not just people that assume that they're economists and just want to give suggestions because they feel or they think it's beneficial to the economy. So
All
there are a
right.
lot of opinions.
Yes. All right, thank you so much, Oluwadara Olunuga.
Thank
Like
you.
we said, we just hope that one of these days we'll see the implementation of these brilliant ideas and suggestions that have been postulated to the government for the forward movement of the economy. Thank you so much for joining us this morning. Well, we'll take a break. When we come back,
Thank you for having me.
we'll go to the commodities market update.
Welcome back. You're still watching Business Morning. Oil prices steady today after a two-day slump, reflecting the world's mixed economic recovery from the pandemic, with U.S. demand expected to keep rising, while a second coronavirus wave raging in India has led to more curbs on movement. Brent crude was up 18 cents at $66.84 a barrel, having fallen 3% yesterday. U.S. oil gained 37 cents to $63.73 a barrel. After a 3.3% drop in the previous session, gasoline stocks were down by 2 million barrels compared with predictions of an 886,000 barrel fall. Gasoline products supplied a measure of demand that rose by 5% to 9.2 million barrels per day, though this was partly follow-on demand from the Colonial Pipeline shutdown. And now for more happenings in the commodity space, we have Nosike Nwajide, analyst with Financial Derivatives Company. Thank you for joining us on the program.
Always my pleasure.
Well, oil prices have steadied after a two-day slump. Economies are opening, but there's still concerns on COVID-19 cases in Asia, combined with the hike in inflation. Are we on a steady rise here, or is it just a blip?
In my opinion, it should be a steady rise. At the moment, we're battling with contrasting data or conflicting events in the West and the East. In the West, it's a resumption to almost normal, what you call normal activity. The economies are reopened in the US and the EU, while in the East, there's India, there's Taiwan, there's Thailand, and there's also another country where there are really some resurgence in COVID-19 cases, and some cities are instituting lockdown. So you have that sentiment and that negative sentiment on oil and the positive on this side. But I feel as long as there are vaccines, and even it's India, they're one of the biggest producers of vaccines, but somehow that seems to not be affecting the number of COVID-19 cases. But I think over time, the next couple of months, that should be sorted out. And we'll see a pickup in economic activity. The lockdowns will be gone for good, hopefully, and we'll see oil prices steadily rise because it's summer. It's the summer driving season in the US. The aviation industry globally is coming back online, so there's increased demand for oil. So
and we still have the Iran supply issue.
Oh yes, Iran could potentially be bringing back about 2 million barrels of oil back to the international market. Some analysts think that already most of that output is already sold in the black market. So the market already kind of knows this, but it's something that remains to be seen. I mean, the Iran nuclear
But
trade,
it should have an effect.
it should have an effect ordinarily. But some analysts already say, look, there's 2 million barrels of oil that could be launched back into the market, but we know that somehow the Iranians sell this oil. It's a black market activity. But the market is bracing itself. I mean, the talks but on the nuclear deal have made substantial progress, apparently. And in a couple of months, we could see Iran put that much output back to the market. We could see there's also the Strait of Hormuz, where Iran is going to bypass that strait. It's where the oil from the Middle East, basically, a lot of the oil from the Middle East gets into the ocean to the rest of the world. Iran is looking to bypass that because that's an area of great conflict. It's typically when there's geopolitical tension around that area affects oil prices.
And there is tension in the Middle East.
Yes, Iran is looking to bypass that. So in the coming months, it'll be interesting to see how it plays out. But we feel that Iran is an OPEC member. It's been under sanctions for quite some time. It will be interesting to see how, if OPEC Plus is able to tell it to, you need to need to hold out on some of your outputs. I doubt if they will continue. But Iran and Saudi Arabia have over time been head to head
bigger
on a
than
number
the
of issues.
powers.
Yes.
Okay, back here in Nigeria, the Governors Forum, they're asking for deregulation. I mean, we talk about subsidy. We've been talking about this like forever. And there's a PIB
like a
bill
broken
that's
record.
supposed to be passed, and these are supposed to shape the local front when you're talking about oil prices and revenue and all that. How do you see this going?
It comes down to revenue. It comes down to government revenue. I mean, the FAC allocations over time, or right now, the amount the NNPC is subsidizing Nigeria's domestic fuel consumption with is substantial enough to have an impact on the monthly FAC allocations. When the NNPC, for instance, tells you that in the month of May, it's likely not going to remit any like 0 naira to the FAC, that's a problem. And if you were to take out subsidies and sell fuel at the international price, if you just look at the neighboring countries from Cameroon to Niger Republic, Chad, PMS is sold at over 300 naira. And the governors, from their own studying the report that they released, I mean, it could sell for as high as 385 naira or thereabouts. I mean, that would be, the impact would be inflationary. It would be, I mean, we know Labour would fight it. Labour, obviously, it's something that, because I know that the government and Labour are in talks at the moment on how they could go about ending the subsidy. Would you increase the minimum wage? Where's the money going to come from? Nigeria has revenue issues that it needs to sort out. With regards to the petroleum industry bill, there's so much in potential investment that has been delayed, locked away, just because investors are not clear on the fiscal incentives that are supposed to incentivize their investment. So as long as this early in the year, we heard that by the first quarter it would have been sorted out. This is May. We heard that by June, at least the end of June. So we wait and see, and it's critical to the deregulation.
We have a lot of wait and see.
We have so many.
We have to wait and see. We have no choice at the moment.
Well, another big one. Royal Dutch Shell PLC. They've acknowledged that the operations in Nigeria aren't compatible with plans to go green. What would this? What impact would this have on the Nigerian economy going forward?
To begin with, I think it's a cold dose of reality. The world is transitioning away from oil and rapidly away to renewable, cleaner forms of energy. Shell has clearly stated that by 2050, it wants to be known as a clean energy company. Its focus now is climate change and zero carbon emissions strategy. So does that align with its Nigerian operations? No, it doesn't. I mean, the onshore operations, for the past 10 years, they've been slowly, gradually divesting their onshore operations to focus on offshore and gas. They are one of the investors in the NLNG project, and Nigeria is more of a gas economy than oil economy. So it still has, some operations, but it's onshore activity. There's, the insecurity in the Niger Delta, the community oil spills, sabotage, theft, and clashes with community. Those things, there have been protracted legal cases, and especially this major oil spill in parts of Rivers State. I mean, Shell is the one, everybody holds Shell responsible. No one seems to be holding the government, and so everyone seems to point to Shell. So they will obviously sell off their investments. It depends, it's unclear as to who is going to acquire these assets. Are they Nigerian players? Are they foreign?
Are they going to continue in the trend? And then we'll still have the same issue of communities complaining about pollution and things like that.
Yeah, well, if you sell to a Nigerian player, I think there'll be less of that complaint. Now that it's not Shell, it's not the oil giant Shell, it's a local player. Another problem with local player is financing. I mean, Shell used to account for about half of Nigeria's oil output. Now I think it's down to a third, one third of Nigeria's 2.2 million barrels of oil and condensates. So will the local players be able to, the funding for the JVs, will they be able to meet up to that funding? Those are questions that remain to be said. And Shell's divestment is not just in Nigeria. It's not just Shell. It's not just Shell. Other global oil companies are slowly divesting away from Africa. So when you sell off local players, it might be a chance for Nigerian players to even grow around the continent. Maybe an opportunity for growth, and you acquire other Shell assets across the continent.
With this announcement from Shell now, how do you see the federal government actually responding to this?
Well, I think, well, they'll take a long, hard look at themselves. I mean, the PIB, I mean, who knows, if we had passed the PIB, maybe they would have had incentives to stay, but you didn't pass it. Decisions have been made, not here, but obviously at the Hague, the head office in The Hague. And Shell would pull out. Other oil companies have indicated that, or not just indicated, have been actively selling off some assets. So the federal government would need to take a long, hard look at itself. Okay, where do we go from here? Do we actively start participating, not just as a joint venture player, but there's the MPDC. Do we go full on as an oil company and go it alone? Do we partner with Nigerian players? What do we do? They need to sit down and strategize.
And this sounds like a very long process now. If the world is talking about going green now and less demand for oil, and we are still waiting for FAC allocation, which majorly comes from oil, then when are we going to start our process?
It comes down to the subsidy removal. It will be hard. It will be tough. The impact would be dire in some situations and circumstances, but it has to be done. You need to deregulate that aspect of the oil industry so that the governors can have more funds, and channel those funds to infrastructure, to things aimed at lowering the cost of doing business or improving the ease of doing business and making lives easier for Nigerians, having cheap mass transit systems, because obviously the increase in the price of fuel would affect transportation, which would, the price of everything depends on transportation. Moving food from the farms to the markets, that cost goes up. Moving people from point A to point B, that cost goes up. And the inflation right now, talking about inflation at 18, it dropped. I don't see it dropping anytime soon if fuel goes up to 3.
All right, let's look at the market now, the forex market. How's the Naira looking?
It's stable. It's stable in the parallel market. It's been stable since the CBN took away the official 379 value from its CBN website. So everybody is waiting patiently for
no response from CBN yet
for some sort of follow-up announcement, but it's been mute. So you're treading cautiously. If you say nothing, we'll assume that every transaction, or most transactions, are done at the NAFEX rate, which is about 410, 411, and which means that obviously some increased to have the impact on FAC. But then again, the government has come out to say that since sometime in March, that has already been reflecting in your FAC allocation, but there's been no increase in the amount that the FAC have been sharing. So it's something that we just have to wait and see. There has to be some sort of communication. The market's right now on the edge, because it happened in the past where there was a shift, the IFX rate shifted. We thought they had deregulated the market, and the next day, about 2 days later, it went back, or happened on a public holiday, and the next day it went back. So we'll have to just wait and see for the government to come out.
A lot of uncertainty, policy, somersaults, and all that.
So much to wait and see.
Yes. Yeah. Well, just before we let you go, take us through the prices in the agriculture commodities market.
Oh, right now, they're all in the red. All the prices are going up. The major driver...
Still in the red.
Still in the red. The major driver is obviously seasonality. This is the planting season. Well, with the harvest season, it was sometime in July, August. There's the supply chain issues, logistics, insecurity in parts of the country where we grow food. These would affect, obviously, the prices or the amount the amount that you can actually plant or harvest, which would make some commodities scarce and push up prices even further. So at the moment, it's seasonality and the exchange rates. A lot of food items have been placed on the CBN restriction, FX restriction list. So you have to go to the parallel market to source your forex to bring in these food items, obviously at a higher price. So
all right, thank you so much, Nosike Wanjide, for sharing your thoughts with us this morning and for clearing the air on some of those issues. Well, we'll take a moment. When we come back, we'll go to the markets. Welcome back. Well, the market lost 1.48% just yesterday. Airtel Africa lost 10%. Anite, are we safe? What's going on?
Good morning, Nini. Well, it was a pretty bad day for the markets on Wednesday. Like you said, Airtel Africa pulled the market with its red color, just made the market to record
Yeah,
its
I think they
biggest
just
loss.
brought in their color into the market.
Yes, yes. You know, the color red is the color of the bear, and is also a color of sell-off, and it is also a color that means the market is not doing pretty well. That's the biggest loss in just one day, more than just about 1.58%. Take a look at it, 1.48%, and then we're down below the 39,000 psychological level for the all-share index, and then that also translates to about 339 billion naira loss in just one single day. And it was not just the price of Airtel Africa, which went down by 10%. It was also from the negative market breadth of 25 losers, and that's had the massive impact that we saw. And don't forget, in the last two sessions this week, we had a 0.44% drop on the all-share index, and in the second day, we had a 0.72%. So for the better part of the month of May, we've lost a very massive amount, and that's due to intense sell pressure from investors. Now, if you take a look at the volume of activity, it was down. Deals was also down, but the value was higher by some slight margin, and that's because the price of Seplat managed to lift the market's value, and then we had some investors' interest in some other equities. Now take a look at the sectoral performance. Banking sector was down. That's because of the price of some banking bellwethers. Industrial goods was up. Insurance sector was down. And then oil and gas, like I said, is the share price of Seplat and MRS. So now you can see that investors, the stock market is having a resurgence of the bears. Just on Monday, we had thought that the market will open the third trading week in positive. But let's switch over to the unlisted securities market. It was up 1.03%, and then, of course, that shows you that the unlisted securities had some patronage there, although the deals were lower compared to the previous day. Now, to give us more insight about the fixed income market, let's join Alimi from GT Bank. He's a fixed income trader at GT Bank. Thank you for joining us, Alimi.
Hi, thank you, Edith.
Okay. Okay. So now the Treasury, the fixed income market, in particular Treasury bills, has been on a bearish trend. So what is driving this downward trend at the Treasury bills markets?
I mean, the Treasury bills market is actually, how do I describe it? There hasn't been much activity there. Since the last auction where the one-year paper closed at 9.75, what we've seen a bit of demand for that one-year paper in particular, and it's trading a little lower than that at the moment. One of the main highlights we have is the bond auction that happened yesterday, where the DMO sold a total of 175 billion out of the 150 billion they had on offer. They offered the 2027 paper, 2035, and the 2049 maturities, which, we saw an 85 basis points increase on the 2027 paper, a 66 basis points increase on the 2035 paper, and a 35 basis point paper on the longest paper, which is the 2049, from their previous stop rates in the market. What we expect to see in the market today is a bit of demand at the short end of the curve, say for the 2027 and the 2035, because of their strong closing levels. The 2027 closed at 13.1 from 12.25 at the last auction. The 2035 closed at 14% from 13.34 at the last auction. So we expect to see a bit of demand for, around that angle of the curve, and just for, investors to plug their monies. For the Treasury bills, it's going to continue to be a little dull till the next auction, because what we've seen, the trend we've seen is that at every auction, at every primary auction, investors go there to load up the bills, and those that miss out on the auction, come to the secondary market to try and find those.
Okay. Thank you, Caleb Alimi, for bringing us up to speed at the fixed income market. Okay, so now let's, so you can see the market, it's kind of mixed across board.
Yes.
Equities, fixed income market, the debt market
well,
also.
we hope not to see a day like yesterday again in the equities market.
We're just hoping, we're hoping for a rebound. Yes.
All right, thank you so much, Anita. Well, we'll take a break now. When we come back, we'll do an opening call to London. Hello and welcome back. It's Business Morning. We now head over to London where Juliana is waiting to give us an update on what's happening in the UK 24 hours after the inflation data was released. Good morning, Juliana.
Good morning.
So the pandemic seemed to have favored Royal Mail. Their profit increased fourfold to £726 million for pre-tax profit, while EasyJet, on the flip side, posted a loss of £701 million. Well, any more data 24 hours after the inflation data was released?
Yes, it's a tale of two stories of the pandemic, really. I think earnings season hasn't been too kind to the airlines, and today was the turn for EasyJet, the budget airliner based just outside London. They've reported a 6-month loss of about £645 million. Their shares are down by about 3% on the FTSE 250. The domestic market, it's a similar story that we've seen with all the airlines across the world. They've suffered tremendously during the pandemic. These losses compare with about 350 million losses in the same period last year. The EasyJet boss has been doing the rounds on British media, really calling the British government to account. Lots of confusion really about what's happening with international travel. It was supposed to be given the green light on Monday, but now the Prime Minister has changed his tune, saying that he doesn't want Brits travelling to places on the amber list. Unfortunately for him, about 6 million people have chosen to do that during the summer month, which is one of the reasons why EasyJet are breathing a slight sigh of relief. They said they've noticed a massive uptick in bookings very quickly. Royal Mail, they've done stupendously well over the past year or so. In the history of the company, they have never had profit margins that they've seen from delivering parcels. Royal Mail, typically known as a kind of a letter deliverer. Nobody's sending letters anymore. I don't know when was the last time you sent a letter via post,
long time.
Innie. But yes, they've had a great run, which is why they're going to install their dividend. And they said that their pandemic has really opened the eyes about the vision for the company going forward.
Yeah, and the creation of Great British Railways is an exciting one for many British. What's going to be different with this?
Well, if you speak to the union bosses, they don't think nothing is going to be different. They think this new change is basically just papering over the cracks that have dominated the story of British Rail. I would say over the past few years, it wasn't privatised. It was a public firm. That it was privatised about 25 years ago. It was dogged with a series of issues, the rise in fares, the fact that if there was any bad weather, it would completely come to a standstill. The government had long before the pandemic spoken about changing up the franchise system of the rail, and it has. So now it's going to be rebranded Great British Railways. So private firms will still be running the trains. They will be paid via contracts to do this, but the government will be looking after all of the other things, like making sure that ticket fares are fair, making sure that the train stations are running in an orderly manner. But the train line, which trades on the 250, their shares slumped 27%. Clearly, shareholders are not happy with this, but the government have had to step in. I believe they spent about £12 billion in subsidies during the pandemic because, of course, railways get their money through passengers, and passenger numbers have dropped up to 90% during the pandemic. So it's an interesting conversation that's dominating the business pages in London today.
All right, so very briefly now, Brexit sees a €455 billion slump in imports from Britain. Many say these are the realities of Brexit hitting the flow of goods.
It is. This is data pertaining to Ireland. Their Central Statistics Office revealed that exports are falling. I believe 155,000 lorries a year were passing between Ireland and Britain. That's slumped by half. And of course, we know that this is a fallout because of Brexit, because of regulations and notifications that they deem difficult.
A whole lot of aftermath from Brexit. Well, thank you so much, Juliana. I will talk again in the afternoon. Well, going over to the crypto corner now, Ladi is so is pumped up and ready. The correction in the market is, however, persisting. And Elon Musk, I don't know if it's that, if it's China, if it's Ford.
A combination of so much fun. Now, the market is actually very afraid right now. Yesterday, social media was agog with crypto jokes. You know, people, lost a lot of money, trading the market. People that did not take advantage of the, top. There it is, fear and greed index. 11, that's extreme fear in the market right now. Market cap is down to $1.72 trillion, down 6%. The volume is up there, $395.68 billion traded in the total crypto market. And Bitcoin dominance is gaining back up there, 43%. It was down to about 39% a few days ago. Price of Bitcoin this morning, 40,337, a recovery from below 35K yesterday, is up 2%. 24-hour volume, 131.39 billion. Price of Ethereum, $2,704, down 8%. 24-hour volume, 91 traded. Let's see, top odds by market cap. BNB, down 13%. Cardano, down 4%. Doge taking a huge hit there, down 10. And XRP was holding up well yesterday, but today it's not holding up that well, down about 18% at $1.17 a coin. Let's talk to Gilbert Jokpata now, digital market analyst. Hello, Gilbert.
Yes, good morning, Mr. Ladi.
Good morning, Gilbert. Well, this correction is starting to gain attention from U.S. regulators. Is capitulation here?
What's your question?
Can you hear me?
I can hear you now.
All right, Gilbert. So I said this massive correction is getting attention from U.S. regulators, and I'm asking if capitulation is here yet.
It looks like capitulation. The big sell-off, the over 40% decline, and big body bearish candlestick, all this looks like a capitulation at this moment. And we have broken through a number of support at this point.
Is there any more support left?
Well, it depends on investors. One major thing that led to this was investors panicked. But at this point, I think we are going to have a slow walk out. Okay. But if there are more investors out there who think we have not had enough of it, we may find another level. But other than this, I think we are just going to have probably an accumulation and then a slow walk out. This will look more like the 2020 March decline.
Okay. All right. So Ethereum fees are hitting record highs at the moment. What's pushing that up?
Okay, purely network congestion. This is caused by more transactions taking place on the network, which results to miners picking only high transaction costs. Since Ethereum uses more like an auction-based system for miners to pick this fee. So if you have little transaction fee when you're trying to make a transaction, the miners will have to pick their most desirable, which is the high transaction cost. Then if you have a low transaction, sometimes this leads to delay. It may take up to a day, weeks, probably even a month to a decline. So what is happening is majority of wallets have to set a high transaction fee to help their customers aid their transaction. By so doing, even you personally who want to make sure your transaction is going through, you will just have to personally pick the high transaction fee or priority to enable the transaction go through as well.
All right, Gilbert. Gilbert, thank you so much. Let's hope you get some green in this market maybe by the weekend. Thank you so much.
All right.
All right, Ini, top 5 gainers. Internet computer gaining back there, $190, up 36%. It's a tough market, Ini.
Yeah, it is tough at this time, honestly. Yeah. I mean, I thought it was the equities was bad, but I don't know where to turn to now. Say the truth.
These kind of losses.
Yeah. Well, we just have to wait and see. We just have to wait and see, as we normally say. Well, we have a lot of things to wait and see.
Yeah.
All right. Well, that's it for the program this morning. Thank you so much for watching. I'm Ini John Mekwa.
And I'm Ladi Williams. Thank you for watching.